Good morning, everyone, and welcome to this month's HUBSights webinar. My name is Karen Arthur, and I work in the marketing team here at Hubs24. Before we start, I need to mention a few housekeeping items. The lines will remain muted throughout the presentation to prevent any background noise. So if you do have any questions, please use the webinar control panel to send them through to the team. We will hold a Q&A at the end of the session. Today, we're joined by Scott Fletcher, Director of Client Investment Strategies Asia Pacific at Russell Investments, who will present the 2018 Russell Investments and ASX Long-term Investing report and the implications for Australian investors. So without further ado, I'd like to hand over to Scott.
Great. Thanks very much, Karen. Good morning, everyone. So in the next 30 minutes or so, I'll take you through the highlights of this year's Russell Investments ASX Long-term Investment report, as Karen mentioned, starting with a look in the rearview mirror at some of the key findings before looking ahead to draw out some implications for Australian investors, and especially with regard to the ingredients for success in achieving investment outcomes in the years ahead. So without further ado, I'll just give you a very brief about Russell Investments for those of you not familiar with the firm. Russell is a global investment management firm. We're headquartered in the United States. We have about 21 offices globally, have a strong heritage as pioneers of investment consulting industry and particularly multi-manager investing. And also we're pioneers of growth value style investing, multi-asset investing, and this goes back almost half a century. Since that time, or over the ensuing years, Russell's evolved into a global multi-asset solution platform, which is shown on that slide there in terms of the types of investment solutions that we have, from multi-asset through to a range of sector, ESG, smart beta factor, through to transition and trading capabilities. So globally, we manage around 390 billion in assets. We advise on about 3.3 trillion, with some of the largest corporates in the world. And we've always been a research-driven organisation, and it's really about applying the insights to the way we design, construct and manage investment portfolios, which hopefully, in going through this today, you can glean some insights as to the way that you also can construct your own portfolios and your own capital market assumptions and so on. Around the world, we have a research effort that partners with leading organisations, and in Australia that includes the Australian Stock Exchange, to glean those insights across different regions. Now, just to set the scene a little bit, the Long-term Investing report provides an annual snapshot of long-term asset class performance for Australian investors, specifically performance outcomes for the last 10 and 20 years on a pre- and post-tax basis. Since we first started doing this report around 20 years ago, the range of asset classes covered has expanded as better quality long-term data has become available. So you'll see that over time, we've included more and more different asset classes, which is a trend that will continue as quality benchmarks for newer asset classes become available as we go ahead. Copies of the report are available via our website, which is russellinvestments.com.au, and details about benchmarks, assumptions, and even post-tax analysis and so on you can find there. Now, one of the questions that I would ask, and I'm sure that a lot of people would ask, is why would you worry about 10 and 20-year numbers looking backwards? For anyone wondering or asking that question, the reason is quite straightforward. The past has important information about the way we should design portfolios for the future. That goes for us, it goes for any global investment manager, it goes for any advisor building portfolios for a client. And let me give you an example. So if we think about the investment process we use to build client portfolios, we follow a three-step process summarised in our language as design, construct and manage. Most investment processes are fairly similar in this regard, though the actual inputs, analysis, strategy and components will differ from advisor to advisor or business to business, and so on. You'll find that even though these inputs can be fairly similar, the outputs can be markedly different across firms because we have different asset class combinations, we have different time frames, we have different phases of the market cycle and so on. So if you drill into the initial design stage of any portfolio construction, we need to address three questions. It's about the purpose, the choice of assets, and how we account for current market conditions, so our forward-looking assumptions are more realistic. And we don't make the mistake of assuming a particularly unusual set of market conditions, like we've had in a QE world, particularly with the dominance of tech stocks and so on, that we don't translate that too much into the future. So we really need to make some assessments of what's to come based on where our starting point is, and we'll only know that with reference to where we've come from the last 10 years, and hence the long-term investing report type information is quite useful in that regard. So, to the key findings. The Australian residential property outperformed all other asset classes for both 10 and 20-year periods. So we've actually incorporated residential property, and this is a capital city weighted index. So of course, being an asset class index representation, it suffers from other aspects of indexes and other asset classes, which is it's an average, a weighted average, and very much Sydney and Melbourne dominated in a property sense. But with that as a caveat, the most recent 10-year period starts with the worst of the GFC in 2008. And this was a time when property experienced only a fraction of the falls in listed equity markets. This explains most of the performance advantage over global equities for the past decade. So if equity markets behave themselves, which is a somewhat heroic assumption, given some of the volatility, but if they generally behave themselves okay, this sort of dominance of residential property could change quite meaningfully in the next 1 or 2 years, but time will tell. If we extend the time period back from 10 to 20 years, residential property in aggregate outperformed around the turn of the century when the tech bust hit global equity markets. And that's to say the return advantage of residential property over the long term is more about not falling as much when equity markets take a tumble than it is about stellar upside performance through time. And this is an important point to understand about the long-term characteristics of residential property in aggregate. Hence, property's place in a diversified portfolio solution is still pretty key from a diversification sense. So if we just look at the 10-year key findings, as I mentioned, residential property plus hedged global shares and bonds leading the way. Although, where I've said hedged global shares, although the Aussie dollar did decline point to point, it rose significantly against the euro and the pound. So there's a couple of little nuances with regard to those performance outcomes. But you'll note that as we go along that this ranking pattern is what you'll see similarly across the 20-year numbers as well. And also whether we look at results in a pre or post-tax basis. So if we look at 20 years, you'll see a very similar type of result there, just with the slight difference that Australian shares with residential property lead the way as opposed to global equities over the 10-year period. So when we go back 20 years, global shares basically swap places with Australian shares, unlike the 10-year period when global shares, hedged or unhedged, outperformed Aussie shares in 7 of the 10 years. And this was helped, of course, by the run in tech and healthcare stocks, which are larger parts of global indices. The 20-year period, in contrast, includes a strong run of local market outperformance in the aftermath of the tech bust that hit US and therefore global equities hardest. So obviously the US market had gone up an awful lot harder than the Australian market had. It came back an awful lot harder than the Australian market did. And so Australian shares were helped in that sense to outperform global over that period. Now, one of the key findings in any long-term analysis like this is really based in the journey as much as the destination. So I like to think of those two aspects of the investor's experience through any portfolio. And that is, it's one thing to look at the end result of 10 and 20-year numbers to asset classes, but there's a lot more information in terms of the pathway of different asset classes through those 10 and 20-year periods. And so, as I say there, the journey matters as much as the destination. So when we look at the major asset classes of property, equities, fixed income and multi-asset, if we start on the left, property had the top spot in 2001, 2002, around the tech bust in the States and global equities there. And it came last in 04 and 05. When we come to equities, we can see that Australian shares and Australian listed property rankings fluctuated the most. So you find that on the left-hand side with property and equities, as you would expect, being riskier asset classes, they have a lot more variability on a year-to-year basis than those asset classes as you move to the right in terms of fixed income, which is less volatile but still changes year to year. And then a diversified multi-asset portfolio or multi-asset combination, which was by far, as you would expect, the most consistent, being positive returns in 19 of the 20 years covered. So that's in words. The next chart or graphic here shows it in pictures, which I think is far more interesting. So if you look at this checkerboard, dance floor, disco floor, whichever you want to call it, lots of colours on a square, a rectangle, you'll find that from 1998 on the left through to 2017, we've got various asset classes shown there. And I just want to pick on some, particularly for SMSF investors, a lot of direct type of investment exposure on Australian shares, Australian residential property and so on. So if I look at the white one here, this traces out the white line for residential property, and then we look at the orange one, which traces out Australian shares, you'll notice that it's not quite an inverse relationship where one's at the top and one's at the bottom, though when there are very large movements, particularly in global equities, you will find around 2001, 2002, that residential property is top of the pops, and if you look right down the bottom of the 01, 02 columns, you'll find that's the world of global shares, and that's the tech bust. So that particular period around the turn of the century very much sets up the 20-year type of numbers that we see. And then when we get to 04, 05, we see global shares up towards the top, we see residential property down towards the bottom. And this is all very much backing up the point I made earlier about it's not the stellar performance of residential property at all times that drives the 10 and 20-year outperformance of property. It's more the fact that it just does not fall anywhere near as much than equities, which are a riskier asset class. And you see this traced out here, particularly 01, 02, and other issues where we've had the GFC, for example. In 08, we have residential property in the top half there. We have global shares down the bottom again. So you do see this sort of large variation, swings and roundabouts. But I just think it's important just to point out in the residential property sense, it still has a very important part to play in a portfolio from diversification benefit, of course. But just don't go thinking that it's because it's always at the top of the pops and never goes down. So with all that said, there's a couple of things you can do about very wild swings in year-to-year variation between asset classes. You can basically take two approaches. The first one is that you can try and pick the winner. So effectively there will be, and I've seen it many, many times, as I'm sure many on the webinar would see in their client base, or they may know friends and family and so on. But effectively, you can try and pick yesterday's winner, which is the bumpy ride approach. And when you try and pick winners, you've got to become very aware of the limitations of the human factor. And that is all about the behavioural type of tendencies or the behavioural biases, which those of you in the advice will be extremely familiar with. But I do think that one of the ones in particular that is of most of an issue is the herding instinct, the buy high, sell low. That's your classic cycle of investor emotions type of scenario where humans tend to mimic the actions of the larger group. This becomes more and more of an issue in the drive to low-cost investment solutions as well, which are certainly very valid. But one of the issues that we're very aware of as a company that does build portfolios globally is there is room for active, there is room for passive, there is room for in-between, smart beta, and a whole range of things in terms of building an investment solution. But one of the things we find at the moment is just to be aware of the limitations of each approach, and particularly the herding instinct when it comes to indexing, particularly on the US stock market at the moment, where particularly 4 tech stocks can dominate half the return first half of this year, and actually 4 tech stocks or FANG stocks actually drive about 30% of the global equities asset class return through the first half of 2018. So that's something that you certainly have to be aware of. Some of the key observations from our research in this sort of regard about behavioural tendencies and trying to pick the next winner or based on last year's observations, we did some analysis on Australian investors and in the US part of our business as well. What we found was, interestingly, for the Australian investor, if an Australian investor switched to follow the previous year's winner each year, they would be 29% worse off compared to staying invested in a more conventional balanced fund profile throughout the last 20 years. When it comes to the US analysis, and you get some very similar results as well, which I'll show on this graphic, in the US, the average equity investor's inclination to chase past performance would have led to underperformance of a broader American index, which is the Russell 3000, as opposed to Australian market where it's S&P ASX. In America, Russell indexes just isn't a product flog for Russell investments. It's just the fact that the institutional market manages to Russell indexes, Russell 1000, 2000, 3000 and so on. But it would have underperformed a very index type of approach, just buy and hold, by about 1.8% annually. So what that effectively says is when you're trying to chase or pick the next winners based on backward-looking information, there is a cost. And generally over a long period of time, that amounts to something like 1.8% of annual return is the cost of retail chasers. And that is a result that we've seen in the Australian market as well. It is a result that I've seen over most of my career going back to the early 1990s and so on. And I'm sure is something that you've all seen in your experience with clients and investors alike. So approach 2 is the smoother journey. So this is where you're not so much trying to pick the winners. Looking at that checkerboard diagram that I showed before is a very difficult exercise. If you get it right, it's all fantastic and bouquets and roses. If you get it wrong, it's hard times in terms of meeting your client's investment objectives. So when we come to this chart here, I just want to point out a couple of things and put it in the context of either a client coming into an advisor's office or the advisor themselves. So the client walks in with their current situation, which is the blue dot in the bottom left, obviously. Call that capital pool A. They tell you their dreams and aspirations and what they want to do in terms of future goals and retirement lifestyle and so on. And that ends us up at the blue dot more northeast, which is the goal. Joining those two states of the world, or those capital pools, is a return. So if you think of that blue line between current situation and goal, that's your return. Let's call it CPI plus 4%, which is a typical 70-30. We could call it 2, 3, 4, 5, 6, whatever the case may be. But I just want to use this to point out the essence of what we're talking about here. You can either get to that goal or that CPI plus 4 destination using a more volatile way, a more concentrated portfolio, or you can do it using a more diversified type of approach. The greater the swings and roundabouts, means that your likelihood of achieving the goal at the end at that particular time is a bit less than if you have a more diversified and risk-controlled type of approach. So what that means is, of course, that there's a trade-off. So a concentrated portfolio has more potential for upside in good times when the market's going up, but at the cost of greater downside participation in the bad times. Hence, the smoother journey is generally what most people, or not most people, but an awful lot of investors and particularly advice clients prefer, because let's face it, not everyone's after a very wild ride. There are that element in any client base, of course, and there's certainly that element in institutional markets as well that we deal with. But by and large, if you can find a diversified approach that doesn't over-diversify to put in jeopardy reaching a return goal, but that is sufficient diversification to achieve the goal at a lower risk type of approach, that's a preferred way to invest. So with all that said, putting it all together, we've seen property in the white line, we've seen the orange line there traced out for Australian shares. And if you looked at a multi-asset portfolio, which is a composite of a 70-30, 70% growth, 30% defensive assets like fixed income and cash and so on, if you put that together, and that's just an index, putting indexes together in certain proportions, it's not actually an actual fund, you see that the profile is very much smoother and generally sits around the middle to the sort of second quartile of those particular asset classes year in, year out. And as I mentioned, I think it's 19 out of 20 of those years have been positive returns. But you see, though, that the trade-off is that the multi-asset line there is below the orange line when share markets are going through a bullish market phase, and that's the implicit cost of diversification. But you don't get the big downdrafts either. So it is a trade-off between missing out on some upside to make sure that you have less downside participation, and that's what diversification is all about. So with all that said, what are the implications for Australian investors? So really I'm asking, does the last 10 and 20 years have anything to tell Australian investors about what's likely to happen in the next 5 or 10? Well, we think it does. So This is the sort of challenges or the investment challenge that most investors will face at this point in time, particularly with the US being 60% of the world equity market and tech stocks being such a driver of that. Valuation is quite a considerable stretch for that aspect of the global equities market. And of course, the American market is a key driver of global markets. That's the same in bonds as it is in equities. So we think there is more downside than upside potential, given we believe that we're in a late cycle, momentum driven, lots of up and down momentum flows, in many cases expensive valuations, with the exception, of course, of emerging markets, which have become increasingly cheaper over the last little while. Risk is basically skewed to the downside. So this gets back to the point I made earlier about the two approaches. The first approach being trying to pick winners. If you're trying to pick winners, you're trying to pick particular turning points in different asset classes and hit the rotations quite tightly to make sure that you're hitting next year's winner and then the different winner the year after that and so on. Investment in this sort of volatile late cycle market is all about identifying the risk skew in the market. You are not going to be able to generally pick, consistently anyway, turning points in markets. So what you have to do is you have to identify where the skew profile of the risk is. Is risk from this point on, given where we are in prices and valuations and the position in the overall investment cycle, is risk skewed to the downside from here, or is risk skewed more to the upside? We think it's skewed to the downside. Volatility is set to increase. Low volatility reveals investor complacency, and you'll know from previous years that the VIX index, as one measure of volatility anyway in the markets, has been exceptionally low for an extended period of time. It's back with a vengeance now, and very much return of volatility is a classic hallmark of late cycle markets that we're in. And so clients or investors are generally trying to find real solutions for these real client problems, which conventional approaches, history will tell us, have not always done that well. So that brings in some different things to think about as to the next 5 years when we think about how to construct investment portfolios based on these long-term numbers. We have significant sequencing risk in this sort of scenario. If you're 57, 58-year-old, about to go in retirement, can't handle as much of a capital drawdown, if any at all. Underfunded clients needing growth without the downside. Concentrated in low-cost passive portfolios are highly exposed. Dynamic solutions providing the same real return with less downside is the holy grail. But there's a range of degrees of success that we've seen across the industry with that in meeting that objective. So in short, the investment challenge, given all the long-term numbers leading up to now and where we think the risk skew is going forward, if we put in capital market assumptions based on where the markets, the main asset classes are at this point in time, we have an inflation rate for the next 5 years, for example. On average, this is an average. So one thing I can guarantee you is that 2.4 exactly will probably not be hit, but it's a guidepost. These are capital market assumptions. They're not point estimates that should be held with a degree of absolute certainty. But if we get inflation of 2.4% on average over the next 5 years, if we put in that 70% growth, 30% defensive type combination of index type exposures as a representative balanced portfolio, we'll end up with 2.1%, not the 4%. So on average, we would expect the real return from capital market inputs across different asset classes to not get us to CPI plus 4. In fact, it'll fall about 2% short, we think, over the next medium-term run of 5 years or so. So the investor needs, say, CPI plus 4 to reach their objectives, but the investor will probably get something more like 2.1. So what do we do about that? So the critical success factors to bridge the return gap, there's really 4 elements to trying to bridge this gap. And of course, the ability of an institutional investor relative to a retail investor will be quite different. So institutional investors will be more able to utilize these sort of 4 critical success factors about dynamic management, downside limitation strategies in terms of option structures and so on, additional return sources, which is alternative investments. It's really trying to find additional sources of alpha or excess return inside traditional asset classes and then also trying to find additional sources of beta or alternative sources of beta. And also, everything's about efficient implementation if you think that you're going into a low return environment. So with all that said, the one that for retail investors are most able to do anything about is really additional return sources. So this gets back to the structuring of portfolios. And what we've seen across, so just to give you an insight into institutional portfolios at the moment, you're finding particularly DB funds, which is more of an issue in the United States and Europe than it is in Australia these days, but a lot of these funds are de-risking and have been for some time. We're also finding that there's this transference of growth allocations or rotation from pure equities into more alternative sources of growth assets, things like listed alternatives, unlisted assets, and so on and so on. So dynamic management in terms of all the things that you could do about managing the downside, if you're worried about the downside over the next 5 years or so. Doing something with your market exposure or your market beta is going to make the biggest difference. The issue is, though, in a conventional portfolio, particularly in a retail setting, is they're very constrained type of solutions typically. In a PDS document for any balance fund or whatever, you will find that they are far greater constrained in their ability to do something significant with regard to reducing equity exposure or adjusting equity exposure. So I just want to touch on three things: cycle, valuation, and sentiment, which will hopefully give you a bit of a feel for the things that we would look at an institutional approach if we're worried about more downside skew and risk. These things are picked for specific reasons, these three type of signals. So valuation is more of a long-term signal, cycle is a medium-term signal, and sentiment is a short-term, faster twitch signal. Valuation is what everybody talks about. US market is expensive, or tech stocks, FANG stocks, emerging markets might be cheap, and so on and so on. The problem is valuation is a great long-term signal, but it is a terrible short-term market timing signal and can get you run over because things, when they're trending, can stay expensive for a long period of time. So we need to offset that somewhat or balance that with more of a medium-term cycle type of scores or cycle factors, which is all about where are we in the monetary cycle, the earnings cycle, the economic cycle, and what do those type of cyclical indicators have to tell us about the ability of the current market rally to be sustained and so on. And then finally, we have sentiment, which is very much the overbought, oversold, ranging indicators, trend identification, the faster twitch, entry, exit type things. So in the short term, if you're worried about the short term, you would weight sentiment and cycle the most, and valuation might come up with a weighting of, say, like 20%. If you're looking at long-term portfolio construction, you're looking at valuation being about 80%, cycle about 20%, and sentiment doesn't really have a factor or an input over the medium to long term. So that will just give you a feel as to the sorts of things that you will need to at least consider in thinking about how do I allocate my clients' money, given that we're pretty late through the cycle at the present time, and there are some rising emerging downside risks to come. Downside limitation, the bottom line in all this is the less you lose, the less you have to make up if it's a lower return environment. So this is all about return skew. So I talked about risk skew. You want to try and build in return skew as well. The less you can lose, so if you lose 20% in a drawdown phase, if the markets are about to go down, you need to make 25% on the way back up to at least get square again. So there is that natural skew. But this is why it's becoming increasingly important, and a lot more investors, institutionally and retail these days, are more and more focused on the drawdown aspect of returns, particularly when we get to a 5-year outlook. One of the things that there is a lot of debate about is more in the timing of when will the next down phase be and so on. What there is less debate about is when we look out 5 years, and that's all about there will be a reduction in equity returns into a lower return environment. Just to finish off, and then we'll open it up to some questions. In terms of the outcome focus, one of the ways we do it, real return portfolios have definitely come to the fore in the past 5 years, probably, let's say 10 years in reality in Australia, but particularly the last 5 years. they've been going overseas since the early 2000s, particularly the ones that we have run. We call those our real return series multi-asset growth strategies. The difference really is they have the same destination. So if you look at return objectives, you'll see that they are the same return objective as a more conventional multi-asset fund or diversified fund, plus CPI plus 5, 4, 2. Volatility objective is where the differences start to come in, 2/3 of ASX volatility through to a half, through to a third. And drawdown risk focus is where the biggest difference is. They have a high drawdown risk focus across the board. And then also on the income focus, when you get to more conservative versions of these real return funds, it goes from low to medium to high. Dynamic risk management in the real world, I talked about it using cycle valuation, sentiment scores and so on. This is just a chart to give you a feel for one way that real return type of solutions these days are being far more dynamic in the way that they manage the market exposure or the growth defensive asset allocation. And I've just juxtaposed that or compared that to a more conventional conservative balanced and diversified or 50-50 type portfolio. And you can see that as the cycle matures, there's a systematic adjustment to the actual growth exposures in the portfolio. So you're starting to see that come through more and more in the Australian market these days. If you went to the United Kingdom, for example, this is more your conventional starting point. If you went to the United States, it's more of a newer thing. But if you're on the continent in Europe, that's more of an absolute return type market. So I just say that to just make you aware that in Australia, we can sometimes get not just a home country bias in terms of our investment allocations, but we can think that everybody has a default 70-30 type portfolio around the world. It's just not the case. So in New Zealand, for example, it's probably more like a 50-50 type of portfolio is your default. In America, it's more like 60-40. So Australian investors are certainly a little more exposed to a potential market downturn, having a default sort of 70-30 type of allocation. So that's pretty much sums up everything I want to talk about. So I guess the question to leave you with is, given all that, given the long-term asset class returns that we see from property and Australian shares dominating over one period and property and global shares dominating over another, given we've seen the variability in asset class returns are so significant and so large, the question to ask is how comfortable is your investment journey or how comfortable is your client investment journey likely to be going through to the next 5 years, which is a question to give you some sense of comfort that every investor is dealing with and grappling with around the world at this point in time. So at that point, Karen, I think I'll just open up for any questions that I have.
Fantastic.
Thank you.
Thank you very much. So guys, we're going to open up the lines for questions. So just remember to use your webinar control panel, type through your question and send them through to the team. It does look like we've got a couple of questions for the team here. We're hearing a lot about the Australian residential property market at the moment and the risks of a sharp fall. Does property still have an important role to play in client portfolios over the next 5 to 10 years, or is it time to get out?
In short, yes, it certainly does have an important role to play now as ever. Thinking back over a couple of decades, without giving away ages myself, the amount of foreign economists that have come into the country, even back to the early 90s that I can remember calling the dramatic, catastrophic end of the Australian property bubble, it's been consistent year in, year out, because they look at income relative to asset value type ratios, and they say, well, you're only just behind some Asian countries and so on. While that may be the case on those ratios, there's supply and demand factors, as I'm sure most people would be aware on this webcast. But even if it does have a deteriorating outlook, and that goes capital city by capital city as well. You ask people in Perth and Brisbane relative to Sydney and Melbourne, they've had a tougher time of it since the mining bust, of course. But when you look at that checkerboard diagram that I showed earlier, you'll see that there is a big swapping of places between residential property and global shares or Australian shares. That's diversification 101. So you want something in your portfolio that when it's going well and it's going up, that's great. It just adds to return. But when the larger growth allocations like equities, for example, are going south in a big way, You want something that's more illiquid, going down less, and property certainly fits that bill. So to answer your question more directly, it still has a role to play. Is it time to get out? That would be on the realms of advice, which I personally give, but it's very conditional on the structure of a portfolio that your client's got. So I'm going to have an each way bet on that last bit.
Great, thank you. We talked about diversity today, and when it comes to client portfolios, how much diversification is enough, and has the nature of diversification changed these days?
Yeah, good question. So you can over-diversify, particularly in traditional asset classes. I would start with that point. So it's diversification to a point where you're not compromising your ability to reach your portfolio objectives, which is very fund manager speak for basically diversify as much to get the job done and no more. But you will know that in your portfolio construction generally, because you've got asset assumptions coming in, you'll move, expand and contract different models in terms of how much diversification you have, and then you'll see the return and risk numbers change as well. So that's a more classical way of working out how much diversification is enough. The more interesting point, though, is diversification, the nature of it has changed a lot. As we've seen markets get more sophisticated over recent decades, as we've seen the instruments and the tools and the techniques and the strategies change over that same period. These days, diversification, as we've seen from industry funds, for example, were early adopters of unlisted assets. There's some pretty significant issues with those in a tight, concentrated market, but by the same time, they do provide a similar role, unlisted property, unlisted infrastructure, and so on, very much in the same vein as what I mentioned with property. But a lot of the other side on the listed side is about listed alternatives. Hedge funds haven't had a great run for a little while now, but it's very much about trying to find diversifying sources of return that aren't just a market exposure like infrastructure or property or a whole range of things, but also the way that those returns in those asset classes are generated. So it's diversification not just by asset class exposure or beta, it's diversification by strategy, and it's also diversification by things like factors, value, growth, momentum, size, all those sort of things. That's very much where the institutional market is at the moment, and very much where the retail market is starting. I think on some basic factor type portfolio setups is just starting to get a handle on that aspect.
Great, thank you. Just another question. We hear a lot about expensive tech stocks, the expensive US market, and so on. What are the pros and cons of using valuation as an asset allocation signal?
Yeah, so as I mentioned before, and probably ties into that sort of comment, valuation is, by its nature, in a long-term sense, a good signal or a good estimate of what is the likely future return from here. So if something's expensively priced, the upside is less. If something's more cheaply priced, the upside is more. So it has a lot to say about the future asset class expectations of it. The problem with valuation, though, is it has limited information in a more of a 12-month type time frame. So if we were looking at valuation, it's more of a 3 to 5 year type of input into an investment strategy. It certainly has an input into shorter-term tactical strategy, but it's more of a risk signal. And what I mean by that is, if things like earnings momentum or monetary policy cycle or the GDP growth cycle, which has implications for shares output and shares returns and so on, if that started to deteriorate, then we would look at valuation and see if it's really expensive, that's a risk signal, right? So we would be more comfortable with valuation as a backup in a tactical time frame if everything else was going down. But if cycle and all those sort of considerations that go into strategy were still reasonably positive, valuation takes more of a backseat in the tactical time frame.
Great, thank you. Real return funds have come more into the limelight in recent years. Can you unpack a little more for us what they are, how they're different to traditional diversified funds, and in what ways can advisors use them in client portfolio solutions?
Yeah, real return funds, it's sort of this word that's used almost like you can throw a blanket across 50 different funds and it all means the same thing. It's a very broad church, if I can use an analogy. So some real return funds, at their essence, they're targeted or target return or target objective type funds. They're generally not peer relative, whereas your more conventional diversified type funds are more in a peer relative sense. But they are also for a different type of investor. So if you think about investors or clients in an advisor's business, you would generally have those investors that are very focused on performance for obvious reasons. They'll pick up the front page of the Fin Review every June 30 and see number 1 or 2 or your number 59 or 60 this year or whatever the case may be. Very fee sensitive, not so worried about downside sort of behaviours or downside or drawdowns. Now that's one set of investment criteria or focus. The other type of investor is, for example, someone close to retirement, late 50s through to early 60s, in that sort of retirement window, who can't afford a lot of drawdown hit and they're more sensitive to downside. And so peer relative return is as important as actually hitting the actual CPI plus 4 type of return with significantly less drawdown risk. So there are two types of investors. Real returns don't fit everyone, but they particularly fit that cohort of clients that want to achieve a growth-like return of CPI plus 4, for example, but have a particular sensitivity to downside risk. The experience of the client in a real return type of fund will be when you have a bull market phase and you see, like we've seen 2003 to 2007, and we've seen the last few years up until recently, but we don't think we're out of it just yet. You'll find that real return funds, because they're risk-focused or they're just focused on a return objective, they will start de-risking as the markets go screaming north, because they don't need to wear as much risk to hit CPI plus 4 anymore. And so they lag in a very large upward bull market type swing. That said, they certainly outperform in the down market because they have a tighter control on risk. So they are systematically de-risking as the market gets more expensive, and they are re-risking. And to put it very simply, if you think about the cycle of investor returns, which I'm sure many on the call would be familiar with, you see at the top of a market cycle, that's the point of maximum financial risk, where it's all euphoric and it'll last forever, and then everyone loads up on equities and so on, and then all of a sudden, hey presto, we're going down the other side. And then there's the bottom of a swing. Let's call that early cycle, and what we're at the moment is late cycle. Real return funds will increase significantly, our real return funds will increase significantly the growth allocations early cycle, when you've come down from the big fall and things are better value, but they will be reducing late cycle. So they will lag in a late cycle momentum type market like we've had at the moment, but they will generally be expected to provide significant return performance in the early part of an upswing. But overall, that all matches up to tighter range around CPI plus 4.
Great, thank you very much. It looks like we've come to the end of our questions, so I might wrap up. Thank you again, Scott, for presenting, and to everyone who dialed in. If you'd like to get in contact with Russell Investments, please speak with your BDM or call our support team, and they will put you in touch. Thank you again, and have a lovely day.